Welcome back to Switzer on Australia's Business Channel. After a bad day at the office for stocks, is this a sign of things to come, or is another buying opportunity looming? To see how Tom Elliott, Chief Investment Officer with Beulah Capital, is assessing the current lie of the land on the market, he joins us now from our Melbourne studio. Hi, Tom.
Evening, Peter.
Now, mate, are you happy that the election's been called? Is that going to be a good thing for the economy and the stock market?
Look, I think just getting the election over and done with will be a good thing for the stock market. Look, history tells us that in the lead up to an election, there's always uncertainty. People fret about who'll win and what it might mean. And then once someone has won, 2010 being the obvious example, people forget about it and get on with business. So look, I think having the election sooner rather than later was a good move by Kevin Rudd for the economy. And I think we're just going to get the next 4 to 5 weeks over and done with.
Yeah, and do you think the fact that we were told in February effectively the election was going to be on September 14, there's been a bit of a break on some sectors of the economy?
Look, I think it has. I mean, the most obvious one is retail. You know, anybody involved with retailing tells you the consumers are just not sticking their hands in their pocket, of course. More recently, the new car sales have apparently fallen off a cliff if the anecdotal evidence is to be believed. But look, for big companies, banks, miners and so forth, I think life for them continues on, irrespective of whether or not there's an election. There's a couple of sectors, of course, which have been badly affected, in particular salary packaging, for example. But I think the election there might actually throw up a few opportunities for, well, short to medium term investors.
Okay, mate. So, generally speaking, looking at the stock market, like today was probably a surprisingly big sell-off. What's your feeling, say, medium term, say 6 months, year out? Where do you think the market's going to go?
Look, I think it's pretty good. I'd probably agree with Charlie Aiken, your previous guest. You know, he's quite bullish, although then again, Charlie is pretty much bullish all the time anyway. I think he was bullish during the global financial crisis. He won't appreciate me saying that, of course. But look, I like the market at the moment. The Australian economy is slowing, so there's no getting away from that. The mid-year economic forecast wasn't all that positive. But the US economy is starting to pick up steam. China, even at 7 or 6.5% growth rate, I heard one economist put to me recently, essentially grows a new South Korea every single year. So there's plenty of good reasons to be positive about the global economy and indeed its impact on Australia.
So do you think, Tom, when you hear these people, and even the government, you know, in the economic statement, talking about 6.25% unemployment, which I think has got people thinking that 2014 might be a shocker of the year, I had the feeling we're going to see a turnaround in 2014 and things will start looking better because of the dollar and low interest rates. Am I crazy thinking that?
No, you're not crazy, Peter, despite what some members of your family sometimes say to you. But look at it this way. My contra-indicator in all this is the Reserve Bank. The Reserve Bank gets it wrong more often than it gets it right. So at the moment, if we cast our minds back to 2007, the Reserve Bank had interest rates far too high for far too long. That was actually telling you the things were going to get worse. At the moment, the Reserve Bank, as we know this week, has cut rates down to record lows of 2.5%, probably because they're worried about what's going on. I think probably the Reserve Bank is wrong again, and within, 12 months, we'll probably see that today's emergency rate settings are far too low. So that means, I'm more positive than negative about the immediate future.
Okay, dividend stocks, I brought them up with Charlie. Do you still like them? Because, I know a year or so ago you put together a pretty good portfolio based on dividends. Are you still a dividends guy?
Well, look, I think you have to be at the moment. I mean, yet another cut in rates makes people say, well, gee, it's no good sticking my money in the bank. And, of course, if you stick your money in term deposits and Labor gets up in the upcoming election, you'll have another tax on those as well. So there's plenty of good reasons not to have term deposits. As a result, the banks, the Telstras, the Wesfarmers, even a couple of resources stocks, and Woodside Petroleum springs to mind, have got to be considered at the moment. I mean, Woodside is now more of a dividend stock than a takeover stock, and we've spoken about that before.
Yep, without a doubt. So what stocks do you like now, Tom, and why?
Well, a couple of interesting situations. I'll class both of these as relatively short-term situations. Again, the longer term is harder to predict. I like Investra. Now, we haven't had many contested takeover bids for quite a while. Australian Pipeline Trust is bidding for Investra. It makes a lot of sense for APT to own Investra. They own a lot of the same assets. APT already owns 33% of Investra's shares. I think the Investra board has rejected the bid as being inadequate. I reckon there's another 10, 12, maybe 15 cents on top of the $1.13 that's already been offered. So that Investra is one I definitely like. And the other one for a bit of a punt on the market, I think, is the salary packaging firm Macmillan Shakespeare. Now, its share price has basically halved ever since the government got rid of the favourable FBT treatment on cars. But of course, if Kevin Rudd loses the election, Tony Abbott has said, well, we'll restore the old treatment. So that'll mean salary packaging is back on the agenda straight away. And if you think about it, Macmillan Shakespeare, I believe the share price is assuming that Labor definitely wins the election. It's already had its damage. On the off chance the coalition wins, and that's a better than even chance at the moment, Macmillan Shakespeare shares could certainly recover quite substantially.
Yeah, it's a very interesting point, Tom, and I'm sure some people have already jumped in on that. And I will remind viewers that when Roger Montgomery was on the program a week or so ago, he had the company valued around $14. So, but I don't want to put you into it. If you go in it, it is a punt, isn't it, Tom?
Well, it is a punt, but again, I think of it this way. Look at the upside, downside. It's already had its downside. The market is assuming that Labor's policy will succeed. However, if Tony Abbott gets in, and remember the betting market's telling you that the coalition will win this election, well then Macmillan Shakespeare's business model suddenly looks a whole lot better. That would have to be good for the share price.
Without a doubt. Okay, now anything else?
Oh, well, I mean, look, we continue to focus on these income stocks, but I guess one big thing I look at, you know, you said in your previous conversation with Charlie, like, you know, really you shouldn't buy resource stocks for income, but I do think that the falling interest rate environment or the continued low interest rate environment is going to put pressure on the BHPs and Rios to consider returning more cash to shareholders. If they do that, and remember with their dual share structure they can also direct franking credits to Australian shareholders, you might see some of those other resource giants becoming income stocks as well. So just keep your eyes on that.
Okay, Tom, will do. Now, Tom, of course, Beulah Capital is your full-time job, but occasionally you do a bit of radio in Melbourne in the afternoons. And thanks for joining us on the program, mate.
Thanks, Peter. Good to be with you.
Same here, buddy. Okay, so after the break, we're going to look at a boutique hotel for those people who think outside the square.